Good morning, venture capital. This is Metagame, and today we're tracking the number that just flipped AI adoption on its head and who's cashing in. 9 in 10. Let that sit for a second. 9 out of every 10 enterprise leaders say data security, privacy, and risk will directly shape their AI strategy in the next 6 months. Not 8, not 7, 9. When 91% of a market agrees on anything, that is not a preference. That is a market condition, and market conditions have pricing power. Here's the question I want you sitting with for the next 10 minutes. If privacy is now a gating function for enterprise AI deployment, who owns the gates? Because here's what the data is telling anyone who is paying attention. Enterprises are not quitting AI because the technology stopped working. They are stalling because they cannot get sensitive data near the models without triggering a legal objection, a compliance review, or a board-level conversation that nobody in the room wants to have. The privacy barrier is not a side effect of the ROI gap. It is the mechanism. And once you see it that way, the entire investment thesis shifts. Let me set the table. KPMG's Q1 2026 AI Pulse survey puts average U.S. enterprise AI spend at $207 million per organization. That capital is moving. It is committed. It is budgeted. And yet 65% of those same organizations report difficulty scaling AI beyond the pilot stage. MIT puts the pilot failure rate at 95%. S&P Global confirms 42% of AI programs get abandoned outright. Spend is up. Scale is not happening. That gap has a name, and increasingly it has a cause. 1 year ago, 53% of organizations cited data privacy as a meaningful barrier to AI deployment. Today, that number is 77%. 24 points in 12 months. That is the fastest growing concern in the entire KPMG dataset. For context, cybersecurity as a general AI barrier sits at 80%, the longest standing technical concern in enterprise IT, and privacy has nearly closed that gap in a single year. The velocity here matters more than the absolute level. A 24-point annual gain does not signal a plateau. It signals a category in acceleration, and categories in acceleration precede financing cycles in the vendor layer that addresses them. Now here's the data point that should stop every allocator in this room cold. In Q4 of 2024, 23% of organizations said they prioritize AI agents from trusted tech providers. By Q1 of 2026, that number is 72%. 49 points, 2 quarters. That is not incremental movement. That is a category reset. Enterprises are not just saying they care about privacy in the abstract anymore. They are running it as a vendor qualification criterion before the product demo happens. Trusted tech provider is not a marketing phrase. It is a procurement filter. And if your portfolio company cannot clear enterprise security review, it is getting filtered out before pricing conversations even start. Let me break this down directly. When an enterprise procurement team says trusted tech provider, they mean show me your compliance posture, your data governance architecture, your audit trail, and your liability framework before we talk about what the product does. That is the new front door. And right now, 72% of enterprise buyers are standing at that door with a checklist. The startups that cannot hand over the checklist do not get in. They do not get a second meeting. They get filtered quietly, efficiently, before anyone on the sell side even knows it happened. There is a fourth data point that defines the operational ceiling for agentic AI right now, and it is the one the pitch decks are not accounting for. 60% of organizations will not allow AI agents to access sensitive data without a human in the loop. 60%. That is a hard policy constraint, not a soft preference, and it has direct investment implications. The total addressable market for fully autonomous AI agents, the most hyped architecture in the current cycle, is materially smaller than the models suggest. If 6 in 10 enterprise buyers have drawn a hard line on autonomous data access, you're not selling into the market you think you are. But here is the inversion. That same constraint that caps the agentic TAM simultaneously inflates the market for oversight tooling, audit infrastructure, and access control layers that make human-in-the-loop systems operable at scale. JP Morgan's signaled hiring shift toward AI implementation specialists over traditional roles is not a curiosity. It is a regulated buyer building internal capacity to manage exactly this constraint. That is the procurement environment where privacy by design vendors anchor multi-year contracts. The ceiling on one market is the floor on another. Connect the 4 points and you have a chain. Universal leadership concern at 91%. Fastest growing deployment barrier at 77% and accelerating. Procurement filter hardening from 23 to 72% in 2 quarters. Operational ceiling on agent autonomy at 60%. Each link in that chain is a product category. Each product category is waiting to be funded. The AI labs are reading this correctly, even if the broader VC market is not. OpenAI and Anthropic are both formalizing large enterprise deployment vehicles with private capital partners. The largest model providers on the planet are not treating enterprise deployment as a self-serve motion. They are building mediated, governance-heavy implementation layers. That is a structural concession. Even the people who built the most capable AI systems in existence are acknowledging that trust infrastructure is now table stakes for enterprise adoption. When the model providers are conceding the point, the debate is over. $242 billion in AI-specific venture capital deployed in Q1 2026 has accelerated enterprise exposure to AI tools faster than enterprise governance frameworks have matured. That mismatch is the entire story. The constraint is not willingness to spend. It is organizational capacity to deploy safely. Privacy by design vendors are not competing against AI adoption. They are the prerequisite for it. That is a fundamentally different go-to-market position than a feature vendor, and it commands fundamentally different multiples. Which brings me to the competitive frame and the 3 questions every allocator should be running against their portfolio right now. First, is privacy by design in your portfolio positioned as infrastructure or as a feature bolt-on? Because the enterprise buyer is making that determination at the qualification stage, before pricing. Infrastructure gets budgeted in a different line item with different approval authority and with different renewal dynamics. Features get cut in a downturn. Infrastructure gets renewed. Second, which of your companies are benefiting from the 60% human oversight mandate and which are being limited by it? Because those are 2 completely different investment theses sitting inside what looks like the same AI category. Get them confused and you are holding the wrong position. Third, is the 77% privacy barrier reading creating urgency in your deal sourcing, or is it getting discounted as enterprise slowness? The 24-point annual gain says the window for early-stage entry into privacy infrastructure is compressing, not extending. The allocators, who wait for the trend to mature before entering, are reading the signal backwards. By the time a category is obvious, the entry multiples reflect it. There is a risk profile worth naming directly. Horizontal AI tooling without embedded privacy architecture is being filtered out of enterprise procurement at the qualification stage. The 35% drop in horizontal SaaS valuations this year is partially explained by exactly this dynamic. Buyers are not just preferring vertical specificity, they are demanding compliance-ready posture. A portfolio overweight in general-purpose AI applications without governance layers is exposed to a procurement filter that is already operating at scale and getting stricter every quarter. The 49-point jump in trusted provider preference from 23 to 72% in roughly 2 quarters suggests a consolidation event is approaching, either through M&A or through a breakout financing round for a credentialed privacy layer vendor. No such mega round has surfaced yet, which means the window may still be open. But windows that close on procurement preference shifts tend to close fast and without announcement. Here's where we close the loop. I opened with a question. If privacy is now a gating function for enterprise AI deployment, who owns the gates? The answer? The data is forcing is this. The gatekeepers are whoever can satisfy a 72% procurement filter, navigate a 60% oversight mandate, and position themselves as infrastructure rather than features in an environment where enterprises are spending $207 million on average and failing to scale anyway. That is not a niche. That is the bottleneck in the largest technology investment cycle in history. Privacy was a feature in 2024. It is a category in 2026. The enterprise has voted. MIT says 95% of AI pilots fail. KPMG says 77% cite privacy as the barrier. Those are not 2 different problems. That is the same problem with 2 different labels. And the label that pays is the one with the solution. The question for every allocator in this room is simple. Are you backing the gatekeepers, or are you funding what the gatekeepers are blocking? That's our venture capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.